Next up, from the South Bay, Rusty Smith, Associate Cushman, Wakefield, South Bay office.
South Bay is about 230 million square feet, comprised primarily around the LAX market down to the ports of Long Beach and LA. The total year-end vacancy rate was about 5.4%. Next slide, which is flat from last year. Interestingly enough, the last 2 quarters kind of made that happen. We saw a lot more activity in the last couple of quarters. And then we see quite a bit of gross activity, 12.4 million feet, which is 26% over last year's activity, which is really good. The biggest thing is our lease rates, and the asking lease rates are only down 4% from last year. The bigger numbers is the Class B effective rates are down nearly 20%. So you're seeing a big difference between Class A and Class B, and the asking rates really haven't dropped, but your actual deal rates have gone down quite a bit. Same thing on the sale activity. We're seeing sale prices drop from last year, but you're seeing a large volume. Next slide. One of the biggest indicators for the South Bay is the ports of LA and Long Beach. We've seen the ports import and export volume raise in 2010. We're mixed numbers, 16 to 19%. Our numbers about 19% is what we calculate, and that has a big impact on the South Bay's industrial market and the entire LA basin. 2010, we also seen a lot of landlords really push to keep their existing tenants. That's where we see the majority of the deals take place, and because of that, you see the lease rates kind of stick a little higher in the Class A especially. The majority of the actual vacancy right now is in our Class B. Our Class A is still strong. We don't have very many buildings that are available, but Class B we have, Class A to Class B. In 50,000 square feet, we have about 5 Class A buildings that are available. In that same size in Class B, we have over 35. So you see a big discrepancy between the two. Next slide. This graph just shows the number of TEUs for the volume between the LA and Long Beach port, and shows the volume up nearly 20%, which is a great thing. This is actually getting volume back to the same numbers they were in about 2005. So we're starting to see an increase. An increase in port means a lot of buildings getting taken off the market and more activity. Next slide. This graph shows the supply and demand over the past 10 years. You can see that we still have negative absorption, but it's less than the past 3 years, which is a positive sign. We're only down about 500,000 square feet in 2010. So it's the first time it's a less of a bad thing, I guess, and it's starting to have an increase back up, and we're looking for next year to kind of pop over that zero mark and start to see some increase. Next slide. This is where you see the asking rates only down 4%. So it doesn't really show you where the market is. A lot of the asking rates, people are still holding pretty strong on those numbers. But if you see the next slide, this is where you see the big difference. Class A to Class B. You see almost a 20% drop between 2009 and 2010 in Class B product, where you see Class A still kind of holding strong on their numbers. Once again, that has a lot to do with renewals and the lack of available Class A buildings. We're starting to see that flight to quality that you've heard kind of through the night. A lot of these tenants that have been in Class B buildings for a long time are looking for that better building. There's just a lack of that amount of product in the South Bay. Next slide. Here's a couple significant lease transactions. These are both Class A buildings, and you can see where the rates are. The SIVA deal. The previous tenant inside there was Hitachi. Hitachi had taken another building just down the street, so they had an obligation left on their lease. They paid about $1.5 million to Watson to get out of their lease. SIVA came in and leased the building, 57 net, pretty healthy number. That was back in about July. And then also the building down in San Pedro, 60 cents net, BlackRock owner, pretty good lease rate on a Class A building. Next slide. Couple of significant sales. These are investment sales, and each one's a little different. The first one, Class B building, Morgan Stanley owned it, sold for $76. 7% cap rate. People are starting to take the in-place rents, throwing them out the door, saying, let's look at where the market actually is. So the lease rates don't make much sense in the cap rate, but you're still seeing a pretty healthy number, I think, on a sale price for an investment in the South Bay. The next building is a deal we were part of. The building only had, it has a little background to it, there's only 18 months left on the lease. The tenant will not confirm that they will stay in the building. Cabot is coming back into the South Bay, and so they bought the building on an 8.9, but there's only 18 months left in the lease term, so it's a little misleading. But $70 a foot, pretty good number. Interesting enough, this building was out to market for about a year and a half with no activity. We put it back on the market just kind of quietly, and all of a sudden had 3 offers above where the owner wanted the deal done. Next slide. The forecast for 2011. Trade volume, South Bay is all about the ports. So the trade volume, as we see it increase, we'll see that the warehouse demand start to increase also. We're going to see more positive numbers because of that trade and the turnaround in demand. One of the other big things is the increased activity in both user sales and leasing. And with the buildings being taken off the market, it'll start to pick the market up a little bit better, and you'll see a little bit higher lease rates towards the third and fourth quarter. Class A buildings, lack of available buildings right now. They come off the market quick when they are out there, and we just don't have very many Class A available. Class B, we're going to continue to see extended marketing times and large concessions from owners. There's just a number of Class B buildings out in the market right now, and it's just difficult to get them off the market. It takes a lot longer. Thank you.